two big pieces of macroeconomic news during the week ahead concern Britain and Europe. On the domestic front, inflation will once more take centre stage on Tuesday the 22nd of May. The Bank of England has already backtracked on strong hints of a spring interest rate increase, but any stubborn signs of inflation could still put a hike back on the agenda for the second half of the year. And a weak pound and a bubbly oil price could indeed nudge inflation higher. So, the benchmarks to watch are the Consumer Price Index, or CPI, where inflation was 2.5% in March, the bank's preferred measure CPIH, which includes owner-occupier housing costs, which was 2.3%, and the Retail Price Index, or RPI, where inflation was 3.3%. We can see the trend in all three indicators here. Turning to Europe, there are two important economic sentiment indicators due out in the coming week. Belgium's Courbe Synthétique, or synthetic curve, on Thursday the 24th of May, and Germany's IFO business confidence survey on the 25th. Last week's reading on the Courbe was +1, and on the IFO it was 102.1. The trend in both is shown here. So what, you might think? Well, don't forget that a key stock market narrative has been the globally synchronised upturn, an acceleration in growth and potentially the long-awaited revival of inflation. Well, we've seen some indicators such as Purchasing Managers' Indices, or PMIs, just come off the top a little bit. And now another phrase that's cropping up as a narrative is, as good as it gets. If the first quarter was as good as it was going to get, that could make life harder for stocks to progress if global growth cools and corporate earnings estimates stop going higher or, even worse, start to disappoint. So these two measures are a good chance to take the economic temperature in Europe at least. There should also be some valuable commentary on a bottom-up basis. Around a dozen FTSE 100 members and a good few from the FTSE 250 are due to release trading updates, publish results, or host their annual general meetings for shareholders in the coming week, and they include oil major BP's AGM on Monday the 21st of May, FTSE 250 retailer Halfords on the 22nd, Severn Trent, miner Antofagasta and support services stock Babcock on the 23rd, Kingfisher United Utilities and Mediclinic on the 24th, and another utility, SSE, on Friday the 25th. But for me, the stock most likely to cause a big fuss in the week ahead is Marks & Spencer, when the High Street bellwether reports full-year numbers on Wednesday the 23rd of May. This is a big set of numbers for Chief Executive Steve Rowe, as these figures cover his second year in charge. Investors will be hoping for some signs of fresh, positive momentum in sales and earnings, although looking at the share price, it's probably fair to say that the bar of expectations is at least set pretty low. The shares are down by nearly a quarter over the past year, making them the 7th worst performer in the FTSE 100 over that time frame. In fairness to Mr. Rowe, the whole retail sector is having a tough time of it, although we should say that FTSE 100 Peer Next shares are up by nearly a quarter over the last 12 months. So that shows what can be done, and it must be said that at least M&S isn't sitting still. Overseas operations are being closed or rationalised, top-heavy management teams are being pruned back at headquarters, pricing points have been cut, clothing ranges overhauled, sub-brands de-emphasised, new food stores opened and underperforming stores closed. Also, note that Chairman Archie Norman isn't known for letting things drift either, so let's see what he has to say after his first year in that position. When it comes to the numbers, analysts will start by looking at like-for-like sales growth at clothing, food and then the UK overall. This next chart shows the quarterly trend over the last 5 years, and the third quarter figures released in January were undeniably disappointing. Food sales fell for the 4th straight quarter year on year, and the decline at clothing and home re-accelerated to leave the firm lagging both the big supermarket combines and the leading specialist retailers in each category. After that, attention will switch to the headline pre-tax profit number. The good news is that Mr. Rowe did at least leave profits forecast unchanged back in January alongside the Christmas trading statement. The bad? Well, that's that forecasts have dribbled lower since anyway, and the consensus estimate is for £568 million. That compares to a headline number of just £176 million last year, but that was hit by £437 million worth of supposedly one-off exceptional charges. So the base for comparison is at £614 million. So the analysts are looking for about a 7% drop in underlying profits. Note also that analysts think pre-tax income will come in slightly lower again in the year that's just begun, before coming in at around 555 million in the year to March 2020. Finally, income seekers may look at the dividend. An unchanged full-year payment of 18.7 pence would equate to a yield north of 6%, but earnings cover is only 1.5 times, which is thinner than ideal, so also watch the cash flow. Net debt ended last financial year at £1.9 billion, and it'd be nice to see that come down. Lower debt means lower risk after all. Thank you for watching, and I look forward to seeing you next time.